Inflation, you're talking about the headline number, and we have a great chart that we have titled Food for Thought, which shows that the food component is turning down. So food is getting cheaper, but we may not necessarily see that filter through to core inflation. Will it? I mean, we're having something of a similar debate in the US right now when it comes to oil prices. They're meant to be transitory in the inflation data, but actually our inflation is stickily low.
That's right. The UK has to contend with the fact that it's got really a big sterling pass-through coming through to inflation. And the work that we've done on that suggests that it can actually take between 1 to 2 and even 3 years for that effect to fully wash out. So I think the UK has a lot of temporary inflation coming through that channel. It's right. I think in the US, it's a little bit more perplexing and a little bit more worrying that even though it's fairly far advanced in its cycle, even though the labour market seems to be tight, we're not seeing that normal relationship, or at least as strong as we would expect, between closing slack and rising domestic inflation. And I think it really provides food for the thought at the Fed, and maybe that's what Yellen was signalling a little bit in the previous meeting.
And interestingly, James and Mark, I just want to point out that Loretta Mester, the Cleveland Fed president, has just given a speech in Cleveland in which she says that she now believes the natural rate of unemployment is 4.75% in the US, not 5% any longer. That's a sea change, really, isn't it, James?
It is, but it's one of the natural things that I think central bankers need to start asking themselves as they see unemployment fall to and even below where they thought the natural rate was, and they're not getting that inflation reimpulse. There's two questions. One, it could be it's just delayed and they can wait for it, or one, it could be actually there's more spare capacity, and that's either in the headline unemployment rate, but perhaps in other measures of unemployment, so underemployment, people working perhaps less hours than they'd like to work. So maybe there is a bit more room in these labour markets than central banks have thought.
Just coming back to the BOE, James, to what extent is the BOE, is its job easier and that it can lean on the FPC, the Financial Policy Committee, who can be a bit more stringent on lending and bank capital levels? Does that mean the BOE can sort of step back and allow the macro-prudential side of regulation to work its magic?
I think that's right. I think it feels a little bit more comfortable now because it almost has two hands. With the one hand, it can look after the macroeconomy, try and meet its inflation target on that longer-term horizon. But it always has to be nervous that you can create financial imbalances, especially if policy is loose for a long time. So perhaps it now feels a bit more emboldened to leave that policy looser for a little longer because it has this FPC with its additional toolkit. And the FPC can feel quite confident and has been quite confident in taking action that it feels should mitigate some of the systemic risks in the UK economy. At the moment, we're seeing them look very, very closely at consumer credit.